Hi, and welcome to Between the Two Chains. Today I'm joined by Arca CIO and co-founder Jeff Dorman. It is FOMC release day when we're recording this, so we talk a little bit about that, a little bit about macro, how the environment's changed versus the first 5 or 6 months of the year in terms of, now there are actual investable opportunities and catalysts matter, even though the macro is continuing to drive the overall market. We talk about the ETH merge, we talk about the future of blockchain and larger companies and Web 2 companies getting involved in Web 3. And it's just a really interesting take on where we stand in the market and where we're going. So I hope you all enjoy. And again, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. Enjoy the show. All right. Hi, everyone. This is Peter Hans, and welcome to Between Two Chains. It is September 21st. We're recording this, and I'm joined by Arca CIO and co-founder Jeff Dorman. Jeff, welcome.
Thank you, sir.
How are things?
Great. Looking forward to another FOMC decision. At the edge of my seat, waiting to see what kind of mystery is unsolved today by the 12 unelected officials who drive all of financial markets.
Well, by the time the episode is released, obviously we'll know not only the outcome of that meeting, but the market reaction. But what's obviously consensus is 75 bips, and that's certainly priced in. Do you have any different expectations or see any chance of kind of anything outside the norm?
No, I think from a digital asset perspective, I think we're certainly not out of the woods in terms of paying attention to macro, but I think it's having a less and less effect, right? It'll have an effect for 1 or 2 days regardless, and then we'll be back to the idiosyncratic events that have been driving price for the last 3 months. So, as in terms of what we're going to see today, I think it's pretty laid out that it's going to be 75 basis points, right? The interesting thing to me about the FOMC meetings has been this is the most transparent Fed we've ever had. I mean, they spell out everything for you before they do it, and they leave absolutely no mystery to it. And they've been doing that for 7 years now, and for whatever reason the markets tend to try to discount that and not believe it. But they even have their own Wall Street Journal author who they give the answer to 2 days beforehand, and he always writes an article every day, or every a day or two before the FOMC, and it tells you exactly what the Fed's going to do. But the market continues to try to pretend that there's going to be some hidden agenda, which just hasn't played out. So I think it's near 100% certainty that it's 75 bips. We'll see what the dot plots look like in terms of what their expectations are for further rate cuts or for further rate hikes into the end of the year as well as into next year. But this is the pattern we've seen in markets, right? You see an equity and a digital asset sell off into the FOMC, then you get the very expected news, and then you generally have a little bit of a relief rally. So I'd expect the same today. And again, that's 1 or 2 days of focus, and then it's back to looking at the all the different events and tokenomics changes and governance changes and restructurings that are happening in the digital asset market, which is making this a much more interesting market, in my opinion.
Yeah, I'll push back a little on your point that it doesn't matter. I don't think that's what you mean. I mean, certainly, macro policy is driving all markets globally and has been for some time. The difference between now and maybe 4 or 5 months ago is that there are opportunities to invest in more nuanced catalyst specific trades, whereas 4 or 5 months ago no one cared because everything was either all up or all down. But macro still certainly drives the direction of the market.
Oh yeah, absolutely. I mean, I think since November of last year, the Fed and central banks around the world have been in the driver's seat. There's no question, right? The overall correlations of every asset are way up over the last 11 months. Even gold is now showing a positive correlation to everything else in the market, which is not normal. So there's no question that this is a student body left, student body right market where everything is being driven by the macro environment. But when you zoom out again to over the last 3 months, really since if you go back to May, June, and you look at when Terra Luna and UST collapsed, and then the subsequent fallout from Three Arrows and Voyager and Celsius and everything else, really since those bankruptcies have been announced, we have definitely been less directionally dependent on macro. Again, the correlations are still high. You're still seeing moves around specific events like Jackson Hole, like the FOMC decisions, but there's been much, much wider and greater dispersion in assets, not just in digital assets, but in other markets as well. So, I think, again, this is a pretty transparent Federal Reserve. They're not really throwing curveballs at anyone. So, there's no doubt that rising rates and inflation are a bad backdrop for investing, but it's not unexpected results that we're getting from them at this stage.
Right, and I mean, it's really an exercise in game theory to an extent in terms of like how forward looking. Do you expect, as someone investing, do you expect the market to be, right? Because, this entire pattern is repeated, many times in the past and will repeat countless times into the future in tightening and easing cycles, right? And, right now we're in a very, I guess significant tightening cycle in terms of magnitude from where we were. And, there will be a time in the future where we're in a more significant easing cycle. It's just, when does the market think that's going to occur? When does that start to price in? And, how far ahead of it does the market try to get? And I think, we had kind of like almost like a fake, whether you want to call it a relief rally, a dead cat bounce. I almost looked at it more as expectations that, we might see either a slowdown in tightening or even straight out easing within the next 12 months. But, what are do you have any different or expectations there?
Well, I mean, let's just be clear, right, that a tightening cycle itself does not historically drive negative returns like we're seeing across all asset classes, right? We've had plenty of tightening cycles.
Sure, but it is right. It is right now.
Well, but for different reasons, right? I mean, if you go back to 2018 and 2015 and 2007, right, those were all rising rate environments where the Fed was tightening. And, in those periods, it was actually when the Fed started to go the other way and started easing again because macro conditions got worse. That's typically when equities and thereafter digital assets have sold off. The reason we're selling off so much on this is not just because of the rate hikes itself. It's because of why the rate hikes are happening, which is inflation, right? And the inflation is something we haven't seen in 45 years. I mean, you can go back and read every single, quote unquote, brilliant investor's take on inflation over the last 10 to 20 years, and they've all been dead wrong, right? Because nobody's seen it in 45 years, right? There's just not that many investors in the world right now who have any idea what the playbook is for inflation. It hasn't been around in 45 years. Again, I've pointed this out in the past, but go look at Paul Tudor Jones's thesis from middle of 2020. He came out with the headline for us in digital assets was Paul Tudor Jones is buying Bitcoin. But if you actually read the 9-page thesis that he put out, it was an inflation thesis. He said inflation is going to get much, much worse, and here are all the different ways we could play inflation. Bitcoin was one of the 4 that they ended up playing. The other 3 were long gold, along a 230s steepener, which basically implied that the rate curve was going to steepen, and it was long the NASDAQ 100. Okay, well, here we are in the worst inflationary environment in 40 years, and all 4 of those are getting killed, right? Bitcoin's getting killed, gold is now down 20% from its highs, the 230s curve has inverted, let alone, not only has it not steepened, it's inverted, and obviously the NASDAQ and tech equities are getting crushed, right? This is not a tightening cycle that is driving the market. This is a fact that we are in an environment that hasn't been here in 45 years and nobody knows what to do, right? This could, the dollar is rising like crazy while we're having U.S. inflation. That's not normal, right? And it's because, the inflation is not isolated to the U.S. Inflation is global, exactly. And the U.S. is raising rates faster than other places, which is why the dollar is strengthening. So you have all these factors, and the easy, lazy thing to say is that we're in a tightening cycle, therefore risk assets are lower, but that's not the norm, right? The tightening cycles usually happen during periods of economic growth, and economic growth trumps the tightening. This is the first time we're seeing economic weakness, we're seeing rising rates, and the Fed having to give up their dual mandate and focus solely on inflation. And again, it's not that it hasn't ever happened before. I mean, those who study history can go back to the Volcker days in the 70s and 80s. But this is, 45 years is a long time, right? I'm 43 years old. I've been doing investing for 25 years, and I've never seen this, right? The 60-year-old investors saw it on their first day as an investment banking clown for, some firm that doesn't exist anymore. So, this is a tough environment. And it's why, if you look across every asset class and every fund manager, they're all getting crushed except for the macro funds. And the macro funds, even them, are getting hurt by the fact that gold isn't responding the way it's supposed to, and the yields aren't responding the way they're supposed to. Right. The only thing that has consistently worked is the dollar rising, and that's just a massive flight to quality, and really more indicative of the uncertainty than it is rising rates.
Yeah, no, I mean, you talked about us raising rates faster than the rest of the world. I mean, the reality of it is, I mean, it's the global reserve currency, right? So it's and as you see, treasury yields are going considerably higher and have been for some time, so that any asset denominated in dollars, which is the majority of assets because it is the global reserve currency, are going to look weaker independent of inflation when you see a strong dollar. So I mean, even looking historically, right, like it's a very different world than it was in the 70s, right? We have the internet, like it's a much more global market, like access to information from a more broad swath of the global population is I can't even imagine how different it is than it was in the 70s, right? So it is a much more global environment than it was in the 30s, 40s, 70s, 80s, 90s even, right?
Yeah, and look, I mean, it makes investing very difficult for anyone, right? I mean, the 60/40 portfolio having the worst, performance in its history, right, down about 17% for the year. The fact that there's, even oil has retreated so much that it's only up like 5 or 10% for the year now after being up 50 or 60% at one point during the year, right? I mean, there really has been no place to go other than long the dollar this year, and that's tough, right? Because each individual investor in an asset class is supposed to be able to outperform their asset class. But if you're a allocator, if you're a pension fund, or you're an endowment, and you're trying to do what has worked for the last 40 years, that's have a little bit of exposure to everything. And if you look across everything they have exposure to, it's all not working right now. Right, which is why you have the highest cash balances we've had in 40 years as well. Right, if you look at hedge fund positioning, it's the longest or the most net shorts and cash that prime brokers have ever seen. Same with the digital assets. We've spoken about this many times. You look at the the amount of stable coins relative to the size of the digital asset market. I mean, it's at an all-time high. Right, almost 20% of the market is now stable coins sitting on exchanges. So it's not like I think. I would never quote Jim Cramer normally, but he always says there's always a bull market somewhere. That's just proving not to be true in this environment. There really hasn't been very many, if any, places at all to go.
Residential real estate.
Yeah. I mean, obviously residential real estate is having you're certainly seeing prices start to weaken in the real estate market. Are you though? Not here. You're seeing more offers. That are out there, but again, even real estate. I mean, this is funny. I know this may not be the purpose of this podcast, but everyone's been talking for an implosion in housing because of rising rates, and you can see the math.
They have no idea what they're talking about.
Well, the problem is if you look at the math, it makes sense. You're saying, okay, well, mortgage rates are went from 3% to 6%, which means and on top of it, the median house price is way higher than it used to be. So as a result, your monthly payment is doubling or tripling if you're buying a new house. But the difference between the real estate market today versus say 2008. In 2008, people were losing their jobs, which means they had to relocate to get a new job, which means they had to sell their house. Today, nobody's losing their jobs. Everyone, and also back in 2008, you had rising rates that were really affecting you because everyone had 5/1 arms that were being affected.
Everyone had negative equity, right? Yep. All the loans were neg am. They were interest-only payments. They reset to considerably higher. They put zero down on their houses, right?
Yep.
They were losing their jobs. And to your point, if they lost their jobs, they needed to move. Now everyone works remotely. I mean, that's hyperbole, but and everyone refied within the past few years. So the motivation to sell your house is essentially zero. So there's no inventory.
Exactly, right. So everyone's focusing on the demand side, like, demand's going to be shut off because of these rising mortgage payments. That's true. There is less demand to buy a house now than there was, 9 months ago as a result of the rising rates and the higher costs. But there's no impetus to sell your house because everyone works from home and nobody's losing their job. So you have this stalemate where in trading terms we're saying the bid ask is widening, right? The bid is lower, but the offer isn't lower because nobody's there's very few people who are being pressured to sell their house. Now that can change, right? If employment all of a sudden tanks and you start to see people losing jobs and all of a sudden manufacturing jobs come back at the expense of tech and stay-at-home jobs, sure, things can always change, but we're just in this weird investing environment right now where it is very difficult to I always say it's easy to come up with a thesis. It's hard to find the way to express that thesis. And I think that's the issue at hand. And that's why I mentioned Paul Tudor Jones a minute ago. It's like everyone had the same thesis, but how to express that thesis, it hasn't really worked all that well.
Mm-hmm. Mm-hmm. Yeah, no, I think that's fair. Well, let's pivot away from macro for a little bit, because I think the one thing that is very fair is, like, I don't see how anyone has any edge in macro, right? So at least the change in environment right now, creates investment opportunities where people can have real edge, which is something that you've been doing and shown for the past at least couple months. So biggest news obviously in the asset class lately was the merge, that took place, very successfully. Frankly, exceeded my expectations. I assumed there would be some hiccups, but really nothing. It did turn into a little bit of a sell the news event, at least in the short term. But yeah, I'm interested to hear your take on that, both kind of, how it went through, and then what you think it means for, both ETH as well as, various protocols built on top of it.
Sure. Yeah. Well, I'll get to the kind of the price action and the investment part in a second, but I think, I'm not necessarily the foremost expert on the technology aspect of what happened with the merge, but I think I want to read something real quick that Galaxy Digital wrote, which I think is really interesting verbatim, just in terms of how important this was. So what Galaxy wrote was, never before has a public blockchain of Ethereum size radically upgraded its consensus mechanism to a new model, and done so without sacrificing network liveliness. At no point were Ethereum decentralized applications and user transactions halted on-chain to allow time for this upgrade to occur. While there were some off-chain service providers, such as exchanges, that preemptively did not offer trading services during the merge, the upgrade itself did not trigger an extended period of network downtime. Switching from proof of work to proof of stake consensus protocol is by far the riskiest code change to date on Ethereum. It required the longest period of research and testing relative to other code changes, and the completion of the merge affirms the powerful potential of open source software development and the abilities of Ethereum core developers to coordinate complex upgrades, even with billions of dollars at stake and an exponentially growing ecosystem of stakeholders operating on the network. And I thought that was like a really, really powerful statement, because we've all been talking about the price action and what's going to happen, and all the math, which we'll get into in a second, of why Ethereum's an attractive investment. But this is a crazy technological achievement that went through 3 to 5 years of testing with multiple, 30, 40 different test nets, thousands of developers working on this across the world. I mean, for this to have gone as seamless as it did, I mean, my entire team at Arca was up, here on Pacific Coast time in Los Angeles. I mean, we were up till, midnight that night, just watching it, just waiting to see what went wrong. And literally nothing went wrong. I mean, nothing. It was flawless, which is pretty amazing. For those who are old enough like ourselves to remember Y2K, it was very similar, right? You're just like, this anticipation to the year 2000 that everyone was like, oh, what could go wrong, what could go wrong? And then, of course, nothing went wrong. And the joke was that, oh, Y2K was a joke, it was no big deal. Well, no, it was a big deal. It's just that they had plenty of developers who were working on it for years to ensure that it went smoothly. And that's the same thing that happened with Ethereum. So I think that can't really be understated, how amazing it is. I mean, Peter, you used to run a tech and software company. Like, how hard it is every time you pull a commit, and you expect bugs to happen, and that's when you have 10, 15 developers all in the same room.
Yeah, I mean, I think from a technological standpoint, it was a pretty remarkable accomplishment, and just to kind of know, okay, we've tested enough. Like, there's no way of really knowing that for sure, and there's no way of knowing that, there's plenty of, brilliant coders and hackers out there, right? That can spend an equivalent amount of time looking to find vulnerabilities, which is also difficult, because it takes a lot of assumption in terms of. But we've seen plenty of code commit pushes that have led to hack vulnerabilities in before, in side chains and others, and pretty amazing.
Yeah, so I think, again, shout out to everybody in the Ethereum community for pulling this off. I know it was a long time coming, but, in terms of price action, I think that's where it probably gets a little more interesting with regard to Ethereum, right? So we always thought this was a 2 or maybe, I guess, 3-part trade, right? So part 1 was the build up to the merge, and we've talked about this at length as well and written about it, but, somewhere around mid-July, I think it was July 18th, is when you got the first sort of definitive date from the Ethereum community that said, this merge is happening, at this block, which was estimated to be mid-September at the time. And then we had a big run up from ETH around 1,000 to as much as 2,000 on ETH, right? 100% gain in that run up just on the certainty that this merge was going to happen. Then you had part two, which was the merge itself, which I think was anyone's guess in terms of the price action, and we'll get to that in a minute. And then part three is thereafter, right? What does it look like in the next 6, 12, 24 months when you have a completely different tokenomic structure in terms of how a value accrues to ETH? So let's get to number two for a second. I don't think anybody thought we were going to fall 25% in 4 days, which is what ETH did. There was a lot of trades that were going on around the merge. There were certainly arbitrage trades where people were borrowing ETH and selling ETH futures, trying to basically just have a net neutral position on ETH, but own the ETH token itself so they could get the ETH proof of work token, which ended up being largely worthless anyway. So the funding costs you were paying to short against your ETH didn't even get offset by the end of dividend that you're getting anyway. So, but you had a lot of those unwinds that happened, right? So anybody who had arbitrage trades on heading into the merge had to unwind. You also had, your typical buy the rumor, sell the news type reaction, which, momentum traders, certainly love taking advantage of that. Like I said, we went into the merge. We had a very strong opinion pre-merge that ETH was going to go higher, which it did for 2 months ahead of the merge. We have a very strong opinion now that Ethereum is going to be one of the best risk rewards for the next 12 to 24 months. I don't think anyone on our team had any real conviction with regard to what would happen in the 7 days around the merge, but I would say that what ended up happening was certainly below our expectations, right? We expected maybe 10, 15% either way. Certainly didn't expect, a 25% move to the downside. We've even heard from multiple dealer desks in the digital asset world that a lot of big investors that were going to come in after the merge to buy because they lacked the expertise to figure out how the merge was going to go, but they wanted to own Ethereum after they knew the merge was successful. A lot of them got cold feet, right? And the reasons for that is, imagine if you're a TradFi firm, right? You're a macro fund or you're an equity fund, and you're trying to convince your investment committee and your boss that Ethereum is a technological achievement and that you want to own it. And then all of a sudden it falls 25% around this big piece of news that you've been talking about. You have to go back to investment committee and convince them, like, hey, no, I'm not an idiot. No, trust me, Ethereum's really going to go higher. Don't worry about the fact that it just fell 25% in 4 days.
Or just what are you missing, right?
Right, exactly. Or what are you missing? Like, why did you get this so wrong? So I think there's been a little bit of a lack of follow-on buying that we would have expected post the merge. But to me, it doesn't change anything with regard to part three, right? Part three is you've got a couple of things going in Ethereum's favor. All right, number one is just math. This was an 88% reduction in supply. So, for those who want to do the math on their own, roughly 13,000 ETH per day used to go out as inflationary rewards to ETH miners to secure the network. That's all gone. So all you have left...
Proof of work.
Oh, under proof of work.
Yeah,
under proof of work mining, right? That's now all gone. That 13,000 ETH per day is no longer being issued to miners. And you have 1,600 ETH per day that gets issued to stakers now for securing the network. Through the beacon chain. So that 1,600 ETH per day is not that much. It's like $2 million of supply. And because of the EIP 1559 proposal that was pushed through about 6 months ago, you also burn a portion of ETH every day based on the transactions that go through on the Ethereum network. So, to make it very simple math, if more than 1,600 ETH per day are burned due to transactions, then ETH becomes what's a deflationary asset, meaning it's an amortizing asset, which means over time the ETH supply will be less than it is today. Now, of course, if the transactions in the Ethereum network are dead and nobody's using DeFi and nobody's trading NFTs and nobody's swapping stable coins, then of course you could have much less than the 1,600 ETH per day burned, in which case ETH will still be moderately inflationary, but certainly much less than it used to be. So bottom line is, unless you think Ethereum of the last 3 years was just a total fraud, if you assume somewhat constant demand for Ethereum, and you know that your supply is going down by 88% or more, it's going to be good for Ethereum, right? This is going to be a long-term winner in terms of the way that token is now designed. And if you look at the tokens that have done the best since the last 3-4 years, and I'm talking about tokens that do well both in up markets and in down markets, they share a very common trait, right? They're all amortizers. They're all tokens that were issued in full on day one, and then they have less supply over time because there's some sort of a burn, right? I'm talking about the exchange tokens like Binance, BNB token, FTX's token, FTT, Bitfinex's token, Leo, Chili's, the sports and entertainment company, CHZ. All these tokens have done well in both up markets and down markets because they are amortizers, because the supply goes down instead of having these massive inflationary tokens like Bitcoin and like some of the other layer one protocols. So if Ethereum is now in that category of being a potential amortizer, it's going to trade well, and it's going to trade very well for the next 2 to 3 years because Ethereum is still the number one leader in every category of blockchain. They're the number one leader in DeFi in terms of TVL. They're the number one leader in terms of stablecoins. They're the number one leader in terms of NFT transactions. The number one in terms of gaming. You put all that together, and if I'm a generic investor saying, I want to bet on the success of blockchain technology, but I don't know how to do it, ETH is the obvious choice. So when you have a token that represents almost everything that's happening on blockchain, combined with the fact that there's now 88% less supply, it's simple math. It's going to go higher over the next 12 to 24 months, independent of what happened in these last, 5 days post-emerge.
Mm-hmm. So let's take a step back from the, kind of future and just go over a little bit kind of, what mechanically happened if you held ETH going into it, and then if you had like a Coinbase account, you could have converted ETH to ETH2 and earned a little bit of yield heading into the merge, and then you mentioned kind of like the legacy proof of work reward token, and now it's just ETH, right? So just go over maybe like what you actually owned and kind of what the difference is, and then how the yield aspect of it works as a holder.
Sure. So I mean, really, as an Ethereum holder, you could have been, in Belize in a jungle for the last week and come back and nothing has changed. I mean, you didn't have to do anything, right? There was nothing you had to do as a user or as an owner of Ethereum, right? You could have owned it in a wallet, you could have owned it on an exchange, you could have owned it in a DeFi application, and it makes no difference, right? You come back, your ETH is still ETH, it's still called Ethereum. All the exchanges, are still recognizing the new proof of stake chain as the Ethereum. So nothing changed, right? It's just, now when you are, each block that has happened post-emerge is just, being run using the proof of stake consensus mechanism now instead of the proof of work consensus mechanism. So all that means is instead of all these mercenary miners who just, try to solve a puzzle and ultimately got paid for doing it, which is how Bitcoin still operates, now you have, I believe it's 38 ETH that you have to own in order to become a staker, in order to run a node. And if you own at least 38 ETH, then you can become a staker on the network, and now you're getting paid that, some portion of those 1,600 ETH per day in inflationary staking rewards for securing the network. Most of the biggest stakers are large companies that are holding ETH on behalf of other people, so that's your Coinbases, that's your Lidos. But as a general user, nothing changed. You didn't have to do anything. But if you did own Ethereum tokens, if you owned it in your own wallet, you might have noticed that you got airdropped something called ETHW, which is the ETH proof of work chain. And all this is that, don't forget, protocols are open source code. Anybody can fork them and run a new version whenever they want, right? It happens all the time, you just don't hear about it most of the time. But there, was a small group of miners who decided that they wanted to keep the Ethereum chain going as proof of work, even though almost all of the Ethereum community, including all the exchanges and everyone else, supported the move to proof of stake. So this Ethereum proof of work chain is basically just a carbon copy of the chain. So basically you have the Ethereum chain, and now you have two versions of it, the proof of stake and the proof of work. The proof of stake is what every developer is building on, what every exchange is acknowledging, and the proof of work chain has almost no economic activity on it. It's kind of like a blank canvas, but it exists, and it exists largely because miners have all this money invested in being able to mine for Ethereum and Bitcoin, and they just lost a big part of their revenue because they can no longer mine for Ethereum. So they helped to create this narrative that the Ethereum proof of work chain will still be viable. And if you look at the price of ETHW, it's gone straight down, and for good reason, right? Because everyone just got it for free, and they said, I don't want this, I don't even know what it is, and they sell it, and the miners are mining it and selling it, and without economic activity to offset it, it just becomes one of these zombie ghost chains. Now, anything can happen. Who knows? In 5 years, for whatever reason, the ETH proof of work token may matter and the chain may matter. But at least as it stands today, not to mince words, I mean, it was pretty much just a money grab by some miners to try to keep this thing going. There's no real reason for this chain to exist as it stands today.
And I mean, obviously it forked for different reasons, but that's not dissimilar from, say, ETH Classic, which is just a different chain, also proof of work, right?
Well, sort of. Right? The difference is there was real contentiousness.
I recall. Yeah.
Yeah.
Over,
If you go
over
back
the reason for that, the reasons for the fork were very different. But,
yeah, back in 2017 when Ethereum forked and you had Ethereum
Mhm.
Classic and you had the new Ethereum, there was a real descent in the ranks in terms of what was right and what was better. And while the Ethereum Classic network never really took off in terms of economic activity, I think they have like $1 million. I think they just reached like $1 million in TVL, which is kind of crazy when you talk about Ethereum having almost 100 billion of TVL. So Ethereum Classic never really took off, but there was a group of developers and users who really believed that that was going to be a better version of the chain. Whereas in this case, there's almost nobody that I've come across that believes in this old Ethereum proof of work chain. It was just hey, we can do this and create a token, and who knows, maybe people will get confused and buy it by accident, and then as a result, we can mine for a little bit and make some money. Like this is about as toothless economic money grab as we've seen in blockchain. And like I said, hopefully it just sort of goes away and nobody really cares about it. I mean, the token's trading at $5 right now, down from 50 when it was 4 or 5 days ago. So and the volumes are basically nothing, right? I mean, there's just not that many people who care about this, and for good reason, right?
Mm-hmm. Mm-hmm. Interesting. And in terms of the yield, so I guess if you are, if you don't own the 38 ETH, but you have it custodied at Coinbase, right? You can decide to stake it within Coinbase's pool, and they're going to capture whatever that spread is. But if you hold it in MetaMask or on a ledger or something like that, I mean, you don't earn anything unless you have enough to stake.
Correct. Yeah. So if you have 38 ETH yourself, you run your own node and do the upgrades and do everything to stake it yourself, or you can pool it with another operator, right? Like so, Lido is one of the bigger DeFi staking pools. You can do it on Coinbase or Binance, where they'll do it for you. And ultimately, the yield will fluctuate again based on the economic activity of the network. But the estimates are somewhere around 4 to 6%. Is what you can earn if you stake your Ethereum. And the reason this is relevant is, almost the entire world runs on this idea of a risk-free yield plus, right? You have LIBOR plus, you have Treasuries plus. That doesn't exist in the digital asset world up until this ETH merge. There is a real world application here if ETH staking yields become the quote-unquote risk-free rate of digital assets, where you say, okay, well, if that's the yield I can earn for basically doing nothing just to secure the most powerful and most well-used smart contract platform in digital assets. Well, if I'm going to do anything else, I need to earn ETH yield plus, right? So you might see a whole new wave of kind of structured products and fixed income built off the back of the staking yield. Now, it might not happen right away. Right now, if you stake, you have to wait, I believe, about 6 months before you can unstake and get your tokens back. So, over time, forgive me, I don't remember exactly the rationale for that, but somewhere around 6 months from now is when you can stake and unstake pretty cleanly. Right now,
Just
if you stake,
a lockup,
yeah, right now you have to lock up for a while. So it's not as smooth today, but 6 to 12 months from now, you might see that risk-free rate fluctuate quite a bit. You might see those, the ETH staking participation fluctuate quite a bit. And that might set a new standard for kind of how we think about risk in the digital asset space.
Mm-hmm. Mm-hmm. Yeah, and I'd imagine, I mean, look, there'll always be a little bit of an equilibrium too, because, you have a couple of moving parts in the yield calculation, right? You have the revenue that's being generated by transactions on chain, right? So the more transactions, the more ETH, I suppose, that is distributed, right? Or does that just factor into the burn in its constant? No, it's a direct result of the transaction volume. Right?
Yeah. So yeah, exactly. Like I said, the 1,600 ETH per day is fixed. That's a fixed amount in terms of what's going to stakers based on just the consensus mechanism itself. Then any additional yield is based on the amount of activity and revenues and things that are going on.
Oh, so there is upside to it.
Yeah, and then the individual yield you're earning is obviously also based on how many participants are staking. Right?
Correct.
Because that 1,600 ETH is being distributed amongst either a small or a large group of participants.
Right.
So several factors will dictate what that yield is, but it definitely is. It definitely is variable.
Yeah, exactly. So transactions go up, more people stake, the revenue is split amongst more people, yields come down, people take money out and move it to something else because it's not attractive enough, or whatever, and then you have this kind of constant equilibrium. Yeah, it's definitely interesting. It's definitely very interesting. And obviously everything is denominated and paid in ETH, right? There's no USD stablecoin option here or anything
Correct.
like that. Everything is done in ETH. Yeah.
Correct. Yeah. So you have to, and that's an important point, right? Because you have to immerse yourself into the Ethereum network if you're going to think in those terms, right? So, for example, if I live in Brazil and I never leave Brazil, and Brazil was a closed economy for whatever reason, had no imports and exports, then everything you would do would be in the Brazilian real. But if you are a dollar, investor or a dollar user, and you happen to invest in a Brazilian bond yielding 10%, but all of a sudden the Brazilian real falls 50% against the dollar, you obviously aren't making your 10%, you're only making 5%. So these yields and everything we're quoting are in ETH terms, but if you're still converting everything back to dollars, then you're going to have a fluctuating return. So we'll see if we end up in a world. I think a lot of people in the Ethereum community believe that ETH really will be a currency, a global currency one day, and actually be more of a medium of exchange than even Bitcoin or stablecoins. I think the jury is still out on that, but there is a world where, as more and more things happen within Ethereum, that you can in fact base some level of your life or of your expenses and revenues in ETH terms. Now we're not there yet, but you're seeing you're seeing pockets of it, right? You're seeing I think it was SocGen that issued a bond on ETH, and obviously, our own Rcoin and Arca is, issued on Ethereum, right? There are some real world things. Anything involved with MakerDAO and real world assets. There are some real things that are being built on Ethereum that eventually tie kind of real world to this separate digital asset world. But I think we're talking a long time from now when you can just look at the yield and compare that to a treasury yield, right? Because a treasury yield is US dollar based, and most people think in US dollar terms. The ETH staking yield is obviously higher than treasuries, but it's in ETH terms, so you have to take that currency or fluctuation risk as well when you're talking about that yield.
Well, one is also the underlying asset of one is also a credit obligation of the U.S. government, and the other is not an obligation of any sort, right? It's interesting. So and I don't want to spend a lot of time on this because I don't think there's anything that we can really say, in terms of motivation. But obviously, there's interpretation of Gensler comments that because of the switch, this now looks like or the yield component of it makes it a security, which is, in my mind, it's kind of it's a major stretch. I know why he's doing it, as a politician, but it's really not any different, right? There was a yield component of it before. It was just for miners, and maybe they were earning the yield off their investment in equipment, but there was clearly a yield component. And now there's a yield component off of the staking. So, nothing has changed too much. There's nuance here and there.
Well, let's be clear too. 99% of the people in the world couldn't care less if Ethereum is a security or not, right? Most
Correct.
people don't care if anything's a security or not, right? If I'm making an investment, it doesn't matter if I make an investment in baseball cards, which is not a security, or if I make an investment in a stock, which is a security, right? The only people who care are the ones who are issuing tokens, because they need clarity on if it is in fact a security, and there's rules they have to follow with regard to filing and issuing a security. And the exchanges where these tokens trade need to obviously follow the rules and have certain licenses if they're trading securities. Correct. So, obviously, I think we've been following Gensler's words now for long enough that, he's pretty much a broken record right now. He's calling everything a security and finding reasons to call everything a security, but yet has not actually been granted the authority to actually govern most of the digital asset space as a result of there being a lack of clarity here in the U.S. on whether these things are or are not securities. So, in my opinion, one, I don't really care that much. If Ethereum is deemed a security, we'll figure it out. The exchanges will have to make changes, issuers will have to make changes, and it'll function no different than any other security investment like stocks and bonds. If it's not a security, then it'll probably operate similar. But in terms of why it would become a security just because all of a sudden there is a stated yield, to me that's a stretch. But no more or less than every other soundbite that's come out of Gensler for the last year.
Yeah, and from his perspective, it's exactly what he wants, right? Because he wants control over, this growing asset class from a political standpoint. And so if, people agree with him, and, Congress needs to act in any way you cut it. But, he's getting a kick out of all this, right? And it's fine. I mean, I like the Montgomery Burns side by side shots I see on Twitter every now and then. Though,
yeah, and this goes beyond probably our scope as well. But there's some dangerous precedents trying to be set. Like just yesterday or earlier this week, there was a lawsuit against an individual, I believe by the name of Ian Bellina, who was involved in some sort of issuance of an ICO, 3 years ago, that they're saying was an unlicensed, an unregistered security offering. That alone is no big deal, right? I mean, we know the SEC has been ruling by enforcement rather than by a guidance. But what was interesting is in the lawsuit against Ian Bellina, they said, basically slipped in something that said, because most of the validators of Ethereum are in the US, therefore everything that happens on the Ethereum network is now a security. And there is and again, this is beyond my scope, but there's a whole bunch of crypto lawyers out there who are stating that the reason for slipping that in is simply they're using this Ian Bellina lawsuit just as a way to slip in that one clause, just so that they can have further jurisdiction over everything that happens on Ethereum for future cases. And then they'll point to, this was a very obvious lawsuit that they're probably going to win, but then they'll point to the success of this lawsuit and say, oh, but in that lawsuit that we won, here was this clause that said we have, jurisdiction over Ethereum because most validators are in the US. So again, there's a lot of politics going on. There's a lot of regulatory and legal stuff that's going on that for most people, again, it doesn't matter. It's like, whatever, own the assets you want, invest in the assets you want, use the assets you want, and one day there will be laws and clarity, and when there are, you'll have to follow them. But behind the scenes, there's a lot of this, song and dance going on, certainly led by the SEC and to some extent the CFTC, trying to jockey the system a little bit for who's going to have jurisdiction and who's going to have final word.
When you say most validators, I mean, under proof of work, sure, I'd imagine there was some, maybe the majority of mining operations were
no, this lawsuit was specifically issued immediately after the merge. So pointing to
got it.
proof of
so
stake.
most, I guess if you're talking about Coinbase, right,
Yeah.
and larger exchanges, but then you have
Yes.
Binance too, and
Yeah, and it wasn't a majority. It was like 45% or something like that. Like, this is still a very global thing, but the majority, like the majority of any single focus was in the U.S. was what the argument that they were making. There was no other jurisdiction other than the U.S. that had more of a representation of ETH validators. So again, the point is, like, this is going to continue to go on.
Until you get congressional action, this is what we're going to see. This is the world we live in. Yeah.
But I do want to point out one other thing too, which I think is important. We've been talking about Ethereum for a while, and for good reason. Again, I do believe that Ethereum is one of the more no-brainer risk-reward investments over the next 12 to 24 months for the reasons we mentioned. But I think it's worth noting that even just in the last month alone, while everyone's been focused on the ETH merge and the price action, you've seen a lot of other things happen. Right? Helium just announced that they're going to go over to Solana. The decentralized Helium being obviously in the telecom space. A decentralized derivatives platform, DYDX, said it was going to move off of Ethereum and go to the Cosmos ecosystem and build on IBC. Starbucks announced an NFT platform with Polygon Matic. There was the consumer electronics company LG is building an NFT marketplace on Hedera. KKR, the big private equity firm, announced that they're going to have one of their funds available on Avalanche. So beneath the surface of all the price action and talk about ETH, there are still other viable blockchains that are still producing blocks and trying to convince developers and companies to build on them. In fact, one of them just the other day too, there was an app called Sweatcoin, which had 100 million users in Web 2. It was not a very U.S. based company, but it was about over 100 million users globally, and they just launched a version of their platform on the Near protocol. And immediately there was 13 million wallets downloaded on Near compared to 10,000 before that. So you're seeing that even though we've been largely in this just isolated ecosystem recently, the last 4 years of organic growth in blockchains, you're starting to see what the real future of blockchain is, which is companies and projects that already have millions and millions of users porting over to these different blockchains. And some of them are going to use Ethereum, some of them are going to use others. It's actually sort of an interesting case study trying to figure out, like, what is the motivation behind these companies? Are they picking a blockchain because they heard of it? Are they picking a blockchain because it's actually faster or more secure? Are they picking a blockchain because the creator of it has the highest marketing budget and just attracted them? But for whatever reason, you're having major corporations and companies and institutions starting to analyze and utilize these different blockchains. So I think that's a story as well. It might not be a story for 12 to 24 months, but just because the talk has been Ethereum, and I think Ethereum is probably the best pure play investment, there's a lot of other things going on as well. And I think that's the next catalyst that we should be looking out for post the merge is, well, how many of these other companies that already have millions and millions of users are going to start using blockchain technology and going to start pushing their users over to certain wallets, and we'll see some growth adoption happening in that way.
Mm-hmm. Yeah, and like you mentioned, Polygon, right, which is a side chain of Ethereum, and that's an interesting one for Starbucks. Probably a very smart choice, just because if you're talking about eventual transaction volumes and dollar amounts of the type of transaction volumes that Starbucks would be, you're going to need speed and you're going to need cost effectiveness, and the advantage of Polygon, which I think is I personally like and use a lot, is just because you can transact for fractions of a penny. I mean, you can have $5 in Matic tokens and it can last forever. In terms of paying for transactions. Whereas you can't buy a latte and pay. I mean, I know prices of Ethereum transactions have come down, but you can go buy $5 latte and pay $20 in transaction fees.
Sure. Yeah, and I think the point is, though, I mean, we are still heading towards a multi-chain world, even though we're talking about Ethereum. Like Ethereum is definitely the most secure network right now, but there's others that offer other advantages, from speed to scalability, etc. So. And again, you go down the list, like there's even more. I think, don't forget Apollo, who's the largest investment firm in terms of securitizations. They picked Figure's blockchain Provenance a year ago to build on. I think Algorand is like the biggest sponsor of the World Cup, and there's a fair amount of DeFi and NFTs activities related to sports that are being built on Algorand. I mean, you just go down the list. We're just in a much better spot in terms of an industry than we were, 3-4 years ago. So people love to make the comparison to, digital assets are in 4-year cycles, and this is no different than 2017. Like, it's not even close to 2017, right? The price action looks the same as 2017 and 2018, where, we went straight up in 2017 and then straight down in 2018. But back in 2018, I mean, there was nothing of relevance built in this industry. And now you have, 7 or 8 or 9 functioning blockchains with real partnerships and real apps built on these. It's a different world. So, I think, again, from a technological achievement standpoint, I think what Ethereum accomplished was amazing. I think from a long-term investment standpoint, Ethereum is going to be incredibly good risk-reward. And, everybody who's trying to make decisions based on what the FOMC is going to do or what inflation is going to look like are, ultimately that's not going to be the driver long-term of Ethereum's success as an investment. But then there's this whole other, world of layer 1 blockchains and the apps being built on it and the partnerships these projects are developing, that are going to lead to, in my opinion, just a much, much bigger investment landscape than we've ever seen in this space before. So, that's kind of my takeaway as well, is all of us were myopic and sort of focused on Ethereum, and now that it's over, it doesn't mean that there's no catalyst. It just means let's start looking at all the other things that are happening as well.
Well, I think that's right on. I do think history rhymes, certainly. In terms of the comparison to 2017, obviously we don't need to go into that environment and why, but you had ICO boom, and you had grabs, and basically people seeing what would stick and what a lot of guesswork, right? And most of those things now are worthless, right? And you've had innovation since then, and I think what we'll continue to see in really kind of like a nascent technology is continuous innovation. Many things die off and go the way of like pets.com, and then and others, the equivalent of like the Netflixes of the world, grow, and will create new opportunities. So just like you wouldn't look at the investable universe of digital assets as what existed in 2017 today, I think in 2027, it'll be very different than what it looks like now, meaning that, the many of the largest opportunities that we'll see, leveraging blockchain are yet to be introduced, or are venture funded companies right now that, aren't publicly investable yet.
Yeah, for sure. So, I think, we started on macro, and we'll sort of end on macro in the sense that, there's no question that there are market forces sort of driving prices across many asset classes right now. But, when you look 3-4 years from now, I think from what conversations we've had with investors as well as other funds, I mean, most people recognize that the growth in blockchain is real. The success stories from DeFi to stablecoins to Web3 to NFTs is real. And from an investing standpoint right now, you're kind of trying to thread the needle right now between the near-term uncertainty in the macro environment versus the long-term, fairly certainty of which of these projects are going to really have that operating leverage to the upside when users and transactions start to grow again. So it's tough. It's definitely choppy waters. It's tough to navigate. But there's no question that there are pockets of opportunity. And I think, again, the last 3 to 4 months, to me, looked very different than the first 6 months of this year. The very first 6 months of this year was just macro, and it was just, the crescendo of the Terra Luna blow up and the ultimate fallouts from that. That's not what the last 3 months have looked like. The last 3 months have been cool restructurings, liquidations, merger and acquisitions, reorgs of token projects. I mean, just a lot more going on right now. Not to mention these huge partnerships from the Web 2 world coming over. So there's a lot to look forward to as a digital asset investor. Plus or minus whatever we get out of the Fed today and going forward.
Yeah, absolutely. Yeah. Well, I like that you kind of took over as host of the show, saying what we're going to end on. But that's I can read the context clues. You probably got somewhere to be. But yeah, no, it's hopefully a helpful conversation for everybody, and we'll do it again in a couple of weeks. So we'll talk soon, Jeff. Thank you.
Yeah, thanks for having me on your show.
All right, buddy. Talk to you later.